Before I begin to this video, let me give a quick disclaimer. I am not a financial advisor. The content of my videos represents my personal opinions and is provided for informational and entertainment purposes only. My information is not intended to be legal, financial, or an investment advice. Always conduct your own research and due diligence before making any financial decisions. Remember, it's your money. Please make informed decisions that are right for you. I'll never ask you for money, nor will I provide my phone number or personal email address. If you encounter any suspicious accounts or messages claiming to be me, please report them immediately as fake or scam accounts.
Welcome back to Talk Stock with me, where we turn market noise into clear signals. Before diving into today's technical analysis segment, let's quickly set the scene with a rundown of the key macro and market events between June 16 to 21st, 2025 that shaped investor as well as trader sentiment. We'll begin with the geopolitical shift in the Middle East. On the 16th of June, reports that Iran sought to de-escalate tensions and resume talks with Israel lifted global risk sentiment. European and US stock indices rallied while oil prices dropped roughly 3% to send the price of crude oil to $72 per barrel. Next, on the 17th of June, there was a report of rising tensions. Escalating hostilities between Israel and Iran pushed the US markets lower. We saw drops between 0.7 to 0.9% in the Dow, the S&P, and the Nasdaq. Investors perceived increased tail risk and oil spiked over 4% as geopolitical risk premium returned. May US retail sales declined by 0.9%, signaling consumer pullback and dampening growth expectations. Remember, alongside with geopolitical uncertainty, this pressured stock prices. Feds hold steady. Ahead of Fed's June 17 to 18 meeting, the markets remained cautious. Positively, US inflation data, the CPI/PC, came in steady or slightly easing. Core PC at 2.1% year over year, reinforcing expectations of a pause, though no immediate easing. The Canadian economy continues to show resilience. Canada's May unemployment rose to 7%, but the TSX hit record highs, followed by strong jobs data and sources stating that the Bank of Canada kept interest rates unchanged amid external uncertainties. Lastly, global growth downgrades. The OECD trimmed its global growth outlook in 2025 from 3.1% to 2.9%, weighing in on European equities. ECB policymakers also indicated potential for further rate cuts this year. Now, how does this set the stage for traders as well as maybe positional traders? In general, we have mixed macro signals plus geopolitical whipsaws. This equals to range-bound back and forth price action. The stock market trends are being shaped as much by inflation, Fed timing, as by oil and geopolitics. Reaction or prediction remains the optimal approach, leading to rules-based systems to capture structured, highest probability moves when clarity emerges. Today, we are diving deep into one of the most important aspects of trading, rule-based trading systems. Now, as we all know, there is a lot of way to make money in the stock market. Some people rely on intuition, others on news, or simply following the crowd. But today, we are focusing on something a little bit more structured. A disciplined, rule-based approach using technical indicators or performance metrics to guide every trade you make. The main question I'm tackling in today's video is, how do we bring discipline into our trading decisions? How can we make rules and guidelines both in terms of discipline as well as using technical indicator or performance metrics to build a consistent, repeatable system? Before we get any further, let's break down what rule-based trading system actually is. Think of it like a recipe. You don't cook a beautiful meal by guessing, do you? You follow steps or rules. In trading, some of those steps might be: if the 50-day moving average crosses above the 200-day moving average on the daily time frame, buy. If the 10-day moving average crosses above the 20-day moving average on the weekly time frame, buy. If the MACD crosses bullish and above the zero line for certain segments of stocks, buy. How is the overall market doing? How is it trending? What sectors are bullish or outperforming the market? Pick the best looking ETFs within that sector or buy. However, if you also want to get more picky within that strong sector, what stocks within that sector are outperforming the market, and lay that on top of some technical confirmation signals, then buy. If RSI crosses below 30 on the daily chart or the weekly chart, whatever it is, it's most times labeled as oversold condition, buy. You sell when price reaches overbought condition. Also, setting tenets like if price hits your stop loss, exit. no point to predict that the market is going to reserve. It's going to reverse at that point. Similarly, when you reach your take profit, do the needful. If you notice, all what I've said are if, this, else, then, that conditions. Basically, these are rules that remove emotion from your decision making. You don't think anymore, you react. You follow the system, you become machine-like, you trade the system, you execute the system, and you trade your edge. So let's talk about backtesting your system. It's one thing to have a system, but how do we know it works? That's where backtesting comes in. You see, with any rules-based system, whether it's something as simple as a MACD crossover or a golden cross, you need to test it. Backtesting allows you to run your strategy against historical data on that specific stock. Remember, you have to backtest for that specific stock, not backtest for one stock and you believe that strategy works for all stocks. You need to backtest for that specific stocks. Backtesting allows you to run your strategy against historical data, seeing how it would have performed in the past, and you are banking that based on how it worked in the past, it's going to also perform in the future. Let's be clear. We understand that every new trade is statistically different from the previous trade because, first of all, you have different market participants, different market conditions, and that is where risk comes into play. Because you understand that this trade is different from the other trades, but your backtest result is telling you that there's a X% chance of you hitting gold. So this is where you need to set your risk to be able to tolerate that in case the environment doesn't, or my edge doesn't work out as planned, I'm going to exit to live to fight another day. Let me show you an example of what a backtest strategy on one of the FANG stocks that I've created, which is based on rule, works. Here on screen, I have Meta, which was previously Facebook on the weekly time frame. You can see the candlesticks as well as the volume bar. I also have overlaid on the volume bar a moving average of the volume. So this can tell me where volume is, somehow different from the 20-day average. So here you are seeing big spike. In this case, this corresponds to selling, and in this case, you can see buyers stepping in. Anyway, what I'm trying to show you here is a rule-based approach that I've created to trade certain segments of stocks that belong to the FANG group. Remember, or now I'll call them MAN group, which includes Meta, Apple, Alphabet, Nvidia, Google, and I will also say Nvidia. Now, this strategy works on the weekly time frame. So I created this rule to work on the weekly time frame only. It doesn't work on the daily time frame. Now I've created a rule to trade this segment of stocks. Now I'm going to come here and release it. I called it MANG. Now when I release it on the chart, what you can see here are a series of buy and sell signals that have been generated based on my rules. They tell me, these rules are what guides me of when to buy and sell. Remember, like I said in my video, it's not only enough to create rules. Anybody can create rules, but you need to be able to backtest it to see how it works on historical data. Now, what I'm going to do is I'm going to switch you to let's see how this signal has been generating signals from the past. Just so you can see where it has been generating signal, buy, exit, buy, exit, buy, exit. This is just based on your rule, not news, just based on rule. Now, this also has a back tested result, and this is what I'm going to show you on this strategy. So now what I do is when I come here, this is showing me the statistics around this signal that I created, this rule. Now this is telling me in the history of Meta there has been 6 buy signals generated. In the past, the win rate is 67%, meaning from the 6 trades, 4 were profitable, and this is the profit factor. This profit factor, again, is defined as the amount of money the strategy made for every unit of money it lost. Gross profit divided by gross loss. You can actually see the individual trades here. When you come here and you expand it, you can see how it has made you money. 43. Let's scroll down to the bottom to see how it has made you money in the past. As early as January 2013, this trade, which lasted almost 3 years, generated roughly 195%. The next trade, 43. These were the 2 trades that you lost money, but you see you are still net positive. The next trade was 56%. The next one was 207%, and there's currently a buy on Meta, which was generated on the 2nd of June, and this trade is currently up 5.97. Another stock which belongs to the group, which we can quickly check. I remember I said, let's do Nvidia. Let's try Nvidia, and let's see the signals that were generated. Again, these are the signals that were generated on Nvidia. Remember, they are different for different stocks. The backtest results are different. You don't use the same for every stock. Again, look at the 806, 190, 496 just by following rules. This is the win rate, this is the profit factor. You can also use this to calculate the expectancy of your signal, where you're going to be doing some mathematical calculations to see how the edge of this plays out. There are many more metrics you can find there. Let's lastly check one more stock before we move on to back to the theory section. Let's go on Google, which is Alphabet. Or let's go with Microsoft. Let's see how this rule-based system works on Microsoft. I like Microsoft as a company. Again, these are the signals generated based on that one rule for this segment of stocks. Here the win rate is 54.17, the point factor is 2.80. So for this, I might not like to use this rule-based system for Microsoft. Although it seems to look positive, but I wouldn't, because I don't like the win rate. It's very low. I think let's just try one more. Google, let's see Google. 69%, and let's quickly look at Nvidia. So this is how you use rule-based system, and you can check the trade signals. Previous trades, you see 2.5, 0.5, 3, 4, and you can see how the signals are being generated on the screen. So let's get back to the theory section. While I show you how I use TradingView to backtest my rule-based system, you can use tools or programming languages like Python or even MetaTrader to backtest your system. When you do this, you are essentially estimating the win rate, the risk to reward ratio, and the overall expectancy of your chosen strategy. You want to know, is this system actually profitable over time? Listen, over time. Not profitable today or tomorrow or next tomorrow, but over time. Once you have those numbers, you can start looking at your system's edge. And that's the key. If your system has a positive expectancy, then over time, it should be able to generate profit. But here's the catch. You need enough trades to let the edge play out. Enough trades meaning at least 50 above. Not 1, not 2, not 3, not 4, not 5. Now, remember, I said no system is perfect. And this is where I need to put emphasis on discipline and risk management. Let's get real. Again, no system is perfect. None. You could have a strategy that shows positive expectancy on paper, but that doesn't mean you win on every trade. Remember, every trade is an independent event. The market participants are different. The climate is different. The macroeconomy is different. Each one comes with its own set of variable and risk. That's why discipline is key. Every time you enter a trade, you have to stick to the system, regardless of how you feel or what others might be saying. This is where risk management becomes your friend. Your goal isn't to win every single trade. It's about playing the long game. Experts actually risk between 1 to 2% of their account capital per trade. This helps them to live to fight another day. Meaning, if you protect your capital and stick to your system, your edge will unfold over time. It sounds easy, but trust me, it's very difficult. I've seen so many traders who find it difficult to remain disciplined. They always look for that next hot stock from social media. Please, if you have a system that has a proven edge, that's how you build wealth. Slow and steady. Now, another important benefit of having a risk-based system is it gives you independence from market noise and social media. And here's the thing. Once you have a rules-based system in place, you no longer need to chase the latest news headline or listen to social media gurus who hype up the next big stock. Your data is your guru. You don't need to get caught up in pump and dump schemes or any of those noise. You've already got a system that's been tested, and that's all you need. Trust your system, not the latest trending stock or the so-called expert giving you tips on Twitter. Lastly, the next phase where all this leads to is something I call algorithmic trading. This sounds spooky. Not really. This is where things get interesting. Once you've mastered your rule-based system, you might think, why not automate it? And that's where algorithmic trading comes in. Essentially, you are turning those rules I mentioned earlier into a set of computer instructions that can trade for you. This means your system can trade automatically, executing orders instantly without needing you to manually click a button. With algorithmic trading, you are not only removing emotions from the equation, but you are also leveraging speed. Markets move fast, and sometimes it's all about milliseconds. Your algorithm can handle the speed, making trades faster than you could ever do manually. So to wrap it up, rules-based system gives you discipline and structure you need to approach the market consistently. You backtest to estimate how well your system performs, then you trade it with discipline, knowing that your goal is long-term growth, not short-term wins. Please, not short-term wins. And remember, don't get sucked into noise. Trust your data, trust your system, and stay focused on the big picture. I also need to mention, not everybody's system fits everybody. Everyone's system was actually forged in fire based on that person's personality and skill set. What the system that works for me might not work for you. So I want you to also know that. Now, guys, if you found this video useful, don't forget to like, subscribe, and drop a comment below. I want to hear about your experiences with rule-based system. Do you follow them? What strategies have worked for you? Please, let's keep this conversation going in the comment section. Thank you. Let's wrap up this week's market digest by providing a review of this week's price action. This week, the US large cap stocks tracked by the VTWO delivered a performance of negative 0.76%. The year to date, the EU has delivered 1.65% compared to last year's overall 24.98%. The short-term trend on the daily time frame exhibits a neutral trend, while the mid-term trend established from the weekly chart is neutral. Moving on to the Nasdaq, represented by the ETF QQQ, this week saw a change of negative 0.69%, bringing its year-to-date performance to 3.05%. The short-term established on the daily time frame is neutral, and the mid-term trend inferred from the weekly chart is also neutral. US small-cap stocks, evaluated by the performance of the ETF VTWO, this week posted a change of negative 0.86%. Year-to-date, VTWO has delivered negative 5.36%. The short-term trend observed from the daily time frame is neutral, and the mid-term trend from the weekly chart is also neutral. Canadian equities, tracked by the ETF VCN, delivered a change of negative 1.87% this week. Year-to-date, VCN has delivered a return of positive 6.97%. The short-term trend on the daily time frame is bullish, while the mid-term trend established from the weekly chart is neutral. Switching on to the Nigerian stock market, which is the clear winner year-to-date, has delivered a week-to-date returns of positive 2.31%. Year-to-date, the ASI has delivered a return of positive 14.78%. Short-term trend on the daily chart is bullish, and the mid-term trend on the weekly chart is also bullish. Switching on to the oil commodity, tracked by the ETF USO, this week delivered a whopping 5.20% returns. Year-to-date, oil has delivered 10.02%. The short-term trend on the daily chart is bullish, while the mid-term trend on the weekly chart is neutral, but there are signs of optimism. Finally, we wrap up the section with Bitcoin, tracked by the ETF GBTC. This week, we saw it shed negative 3.20%. The year-to-date performance of Bitcoin is 9.88%. The short-term trend on the daily time frame is neutral, and the mid-term trend on the weekly chart is neutral. Now, how are we wrapping up this week? Most global markets, from the US large caps to the small caps, even crypto, are in a holding pattern right now. We are seeing neutral sentiment across both short and mid-term, which suggests that investors are waiting for a catalyst, some kind of confirmation before committing capital in either direction. But there are a few bright spots. The Nigerian market stands out with bullish sentiment and a bullish trend, signaling strength and momentum that's hard to ignore. Oil is also flashing short-term optimism, something to keep an eye on, especially if the macro backdrop aligns, for example, escalation in the Middle East. So what does this mean for us as traders or investors? It means we do not need to force anything. Let the market come to you. Stay patient, stay disciplined, and trade your system. In this kind of conditions, reacting to clear signals, not predicting, is the edge. Thanks for tuning in. If you found this helpful, drop a like, hit the subscribe button, and share your market view in the comment section. I'll see you in the next one. Have a lovely week. Ciao.